Hey, it's Richard with Matthews Wealth Management. We're going to do the market update for February of 2022. This video is a little late being done. We are now home, hence the whiteboard is back. But yeah, we'll just jump into it because there's a lot to cover over the last month and a half or so. So as you recall, we've changed up the way that we're doing these videos, not so much numbers up front. Fast forward to the end if you care about that stuff like I do. But I want to cover the highlights, kind of the key topics, if you will, of what's been going on since the January market update. So first things first, at the top I've got a Joe Biden quote, which I found very interesting, and I could spend an entire video trying to dissect this, but too many families are struggling to keep up with the bills. Inflation is robbing them of the gains they might otherwise feel. I get it. That's why my top priority is getting prices under control. Wow, that's interesting. Inflation is robbing them. Gains they might otherwise feel. I don't understand that really. Controlling prices is terrifying. So we all know, if you've been following this, that my belief is that the centralization of all of this is the problem. Let's not continue that to try to create a solution. But anyway, so we've got three main areas I want to focus on here. What is causing all of this inflation, right? And I did a mini series while we were down in Charleston about inflation. Go watch that if you want to know kind of what this is coming from. But these have been the arguments, I guess, chronologically over time. We've got COVID, hence supply chain. Then we've got fiscal policies, which is kind of in the middle for a reason. And now the most recent issue is Ukraine is causing gas prices to go up or whatever. So let's kind of go through them. I'm going to start actually with fiscal policies because I believe that is the truth. I believe that is where inflation comes from because that is what inflation is. The prices are the effect of inflation. So anyway, we've got economic issues and fiscal issues all kind of tied together. We now have 4.8 million jobs more than people able to work them, which again, unemployment is low because that rate is not accurate. That rate is based on not taking into account those that are participating in the labor market. So we have a much smaller labor market. That's why the unemployment rate is so low. So anyway, that's actually an increase from our January numbers of 4.3%. It was 4.6 million excess jobs then, so it's actually getting worse right now. National debt, we went past the 30 trillion mark, yay. We now have unfunded debt of 160 trillion, so that's almost $200 trillion of debt. It's not a good thing. I'm going to do the second section of this video is going to be based on balance sheet and M2SL. Where we can talk about, okay, of our debt, how much currency actually is there, therefore how many years of GDP is it going to take to pay for not only our national debt, but our unfunded liabilities, that's Social Security, Medicare, et cetera, entitlements, which I hate that term. Anyway, I wanted to track Big Mac over the years to see, this was part of an article I was following where they were showing the price of the Big Mac divided by the value of the currency. So they based this in dollars, and they were looking at China and Russia and India and Hungary and all the different countries to see how their currency was being manipulated or devalued, debased, whatever you want to call it. But the Big Mac, being a staple around the world in terms of pricing, can show a discrepancy between the currencies, and that's really what this article was about. But I just threw up the historical numbers for what a Big Mac cost over the years in the U.S. In 2004, it was $2.90. 2010, it was $3.73, and today it is $5.81. So that is just right at a 100% increase. It seems actually pretty linear, so that was surprising. I figured we'd see a higher uptick in the price. However, my belief, if you followed that mini series of inflation, is this hasn't really started yet. We haven't seen the expense hikes that we're about to see, and oil was a good little intro to that. So yeah, expect this linear pattern to go parabolic, basically. So I've got another little tracker here. The financial assets in the private sector is what this is, divided by GDP. So when we look at the stock market valuation or bonds as well. We're looking at all the securities and all the financial assets out there, and we're dividing it by 1 year's gross domestic product. So in 1994, before 1994, I put that number up there specifically for a reason, we were always under 3.5 times GDP, right, as far as how we would value our assets. And so roughly what we're talking about is how many years of production are we going to say something is worth. So if I'm going to sell my business, one way that we value a business is how many years of revenue, would we be looking at there. So if we look at that for the entire country, it's always been less than 3.5 until some specific banking law was passed in 1994. Go look it up. In 2000, which was the dot-com bubble, we got all the way up to 4.5 before it crashed, right? And so this is a measure of crashing markets, right? Once it gets to a certain level, we say, oh, it's overvalued, and then sell. 2008, with the no house left behind, we got to 4.9. Now we're at 6.3. If you look at this graph, it's pretty crazy, but yeah, this is bad. This is really bad. This is bubbles. We're measuring bubbles, right? That's probably the best way to look at this. Is when is there a bubble of when something is valued much more than what it produces? Okay, so we're higher than any bubble if we go by this factor. Lastly, I wanted to point out that GDP, only 10% of our GDP comes from manufacturing. So when we're talking about inflation and we're talking about producing goods or goods of production and costs, therefore, of those things, we don't produce very much. So we bring in most of our goods, and China's a big part of that. But 10% is what we're actually producing. So we're going to be very dependent on these other costs. It's not like we can just pump more oil out of the ground for ourselves or anything. All right, so let's move over to supply chain and COVID. It's not COVID, right? We're done with that. We're not going to shut down the economy because we're not masking up. Like CDC changed the science. Like all of this is gone, right? So let's just talk about supply chain, because that has changed, right? If you've looked through these videos, supply chain is not a, hey, we're bottled up on supply and we got to go back to work. There's truth in that. The key is that our supply chains have changed and that we're trying to restructure to basically get some efficiency in how we produce. But our demand never dropped off. We've got insane amount of demand. People are spend, and it's because of all this money that everybody's trying to spend. We created aggregate demand superficially, and now the supply can't keep up, and that's what we're looking at for why prices are going up. Maybe there's some truth to some of it. I still believe that, when we're printing all of this money, that's where it's coming from. But we got a problem in our supply chain where meat processors are already at capacity, and I know that we're blaming a lot of agriculture and meat people and Tyson Foods and all this stuff and saying they're greedy, right? They're earning a profit and it's not fair, when really it's a capacity issue. And it's, again, because demand is through the roof. And when we look at farms, besides just the meat, we have a fertilizer and nitrogen issue. Prices have shot up, but it's also a supply issue, which we'll get to in a second. But I tracked just the average going costs of fertilizer over the last 5 years on a website. 2018, the price was $75.45. 2019, it jumped up 15% to $86.82. 2020, things dropped. If you remember, a lot of things dropped in price in 2020, down to $70.84. So that was an 18% cut. Last year, it went back up to 82. So we're kind of seesawing 85, 82, 85, something like that. But then now we're at 261. That is a 141% increase. So have we felt this effect yet in our grocery stores? Nope. But this is something else that's moving down the supply chain, right, as far as costs are concerned. Toothpaste, now $12 for a 3-ounce tube. That's just crazy. And we got to keep brushing our teeth. There are memes out there about, I'll gladly pay for more gasoline costs. Well, it's going to be your toothpaste, and it's going to be your food, and it's going to be your way of life that's losing. It's not just gas costs more. Gas is kind of the underlying cost of energy for production. So we'll see that come through. But let's talk about Ukraine real quick before I do the numbers-based part. Ukraine is really just, it's another proxy war. Everything's a proxy war, right? So NATO, and then EAU is the Eurasian Economic Union. So think of the big players here: Russia, India, China. Watch the UN. Who condemned the war? Well, some people abstained from it for economic reasons, and I think I've talked a lot about that stuff. I'm not sure if I've done it on video, but anyway, NATO versus EAU. And so Russia felt like, hey, we need a buffer, and they should have a buffer, I guess, between NATO and themselves for the Soviet Union. But it looks like aggression, and so everybody, it's not right? Like, let's be angry at Russia for what they're doing, but our response to it's probably not linear. The real risk here is how this blows up, not what it currently is. So first things they did was tons of sanctions, right? Everybody's sanctioning Russia. And that's probably the best way to maybe fight a war instead of the gunpowder and rockets and all that stuff. But one interesting thing is that Russia has figured out that the biggest loss of GDP is not going to be coming from the sanctions. It's actually only 10% of their GDP is going to be, or their GDP drop is going to be coming from the actual sanctions. The rest is coming from devaluing their currency. Their financial guy has kind of figured this out, and his main focus is going to be to stabilize the currency, and that will prevent the biggest part of what GDP loss would be, and that's because we've cut off all their transactions in dollars and euros and so forth, right? So Visa, MasterCard, Google, Apple, shipping, everybody is shutting down Russia. That's scary, number one, because like my life, I have Visas and MasterCards. I use Google, and I don't use Apple. I'm a Droid person, but and we import, and that's where my goods come from. So that's crazy. They could just cut you off like that. That's a lot of control there. But number one, since that's a risk, right, to Russia, they're looking at a way to get around that risk. And so we talked about SWIFT and that they wouldn't be able to participate in certain transactions that would make life easier. Well, yeah, so those transactions might take a couple hours instead of a couple of minutes. They're still going to get around it. It's just a matter of what currency are they going to be operating in. So additionally, when we look at supply chain, right, we're looking at sourcing supplies. Exxon, BP, Shell, and Equinor have backed out of all of their drilling things that they were working with Russia on. And those are many, many billion-dollar projects that, now they're like, hey, we're not going to work with you. That's a penalty. See, you shouldn't have invaded Ukraine. However, India and China are jumping in and filling that role. So where those profits were going to come to U.S. companies, they're now going to go to Indian and Chinese companies. They're still going to drill. They're still going to get the oil. They're not going to sell it to us. They're going to sell it to China and India. So this is about basically sectioning off a global economy into NATO versus Eurasian Economic Union. So our sanctions were a good try, but what we're doing is we're breaking apart the world economy. And so whoever can react best to that is going to be have the best advantage going forward. I'm not sure where we should be on that. So SPFS and CHIPS are two different financial transaction processing technologies out there. This one's Russian, this one's Chinese. They're emerging. They are going to be able to do business in yuan, and I don't think dollars in there actually, as well as rupees, or rubles. What are they? Rupees, rubles, they're terrible. But yeah, so if China and Russia and India can work on a separate currency and a separate transaction with their own production inputs and outputs, we're kind of in trouble. And that's where Russia has kind of created a bigger issue that we will feel a lot more than what we have currently from the initial invasion. Export bans. They're banning titanium, nickel, cobalt, uranium, plutonium, fertilizer. Well, we just talked about fertilizer, so that's not good. And just for some reference here, Russia is number 3 producer of titanium. If you include China and their titanium production, that's 68% of the world's supply. Nickel is 11.2%, so if our solution to oil costs is to produce Teslas and volts and so forth, nickel's a big part of that. So is cobalt, and Russia's number 2 in cobalt production. Nuclear weapons or nuclear energy, uranium, plutonium is 60% if you're doing Actually, I think that was Russia and China on those two. Fertilizer, if you look at Russia, India, China, that is the top 3 of 4. I think U.S. is somewhere in there. Or I'm sorry, Japan. Japan was in there. So they are number 3. So 4, I think it was India. But anyway, huge production of fertilizer is coming out of that EAEU. So back in World War II, we had the Axis and the Allies. Well, this would be the Axis that has control of a lot of raw production materials that it takes to run the rest of the economy. I know there's a lot of fear about what happens if China invades Taiwan because they're the semiconductor and chip producers. India accidentally fired a missile into Pakistan. It's weird, but yeah, it's not looking good as far as where this leads. The Ukraine invasion's bad enough, but let's not joke around. Ukraine's government's pretty corrupt. It's pretty bad. Their citizens are completely victims in this whole thing on the global scale as well as just how their government is. And they're having to stay to fight. They're forced to stay to fight, whether they want to or not. But that's a whole different story. I don't want to get into too much of that politics of it because it's the finances behind it that are very troubling, and what comes next as far as all these other costs that we will feel because of our supply chain and because it's a global economy. And then all of this money is going to have to trickle out because the value of the dollar is dropping, and that's kind of the goal. That's what these 3 want, is to de-dollar, right? We want a de-dollarization of the global economy is what they're saying. Russia has an insane amount of gold built up. I saw something interesting the other day about an arbitrage play on gold, where if you can't do business with Russia in dollars, then you buy ounces of gold, you trade the ounces of gold for oil from Russia, and then you take that oil and you turn around and you sell it back for your dollars, and you've just made a ton of money because the valuations are wrong, very wrong in there. And I agree with it. I think the numbers in that specific video are off by a little bit, but the concept is true. There is a big misalignment of commodity prices right now, and currency prices. So anyway, I'm going to stop talking about all this key topic stuff because I think this is the stuff that gets me in trouble in compliance stuff anyway, because I'm right on the edge. But we'll jump into finances on M2 and balance sheet when we come back. All right, we're back. We've got the M2SL numbers as well as the Fed's balance sheet. And I just kind of went, since we're looking back at kind of January, I looked at the January numbers all the way through. So we've got 2022, which is current, a year ago, 2 years ago, and then I went back to 2010. That was kind of after we started with the too big to fail bailouts, and a bunch of quantitative easing was kind of starting up. We had Obamacare passed, so a lot of money printing started then. So it's not like we're pre this age. This is kind of relevant. I didn't want to get that new world kind of caught up in between here. So this should be a decent trend line to follow. Anyway, we've got $21,840,100,000,000 in circulation right now for the month of January 2022. Rewind a year, $19,388,000,000,000. So in the last year, we've printed 12.64% more dollars than what existed before. So if you wanted to go completely literal here, you could say that your dollars are now worth 12% less than they were just a year ago, which was still in the middle of COVID. Pre-COVID, we've gone up 41.75%. So here you're looking at, was that 59 or 58.25% or cents per dollar is what your dollar is worth now. Another way to look at this is if your savings, hesitate to say like 401ks and stuff, but if your savings have not kept pace with these numbers, you are losing the value of your dollar. You can't do that in banks, you can't do that in bonds. The only way to do that is in risky investments like growth stocks and commodities and so forth. And it's unfortunate, but this is why we put a price to time. Time value kind of fixes this. If we go all the way back down to January of 2010, we had $8,455,400,000,000, substantially less. So we have printed, that's 155.38% more dollars in circulation now than what there was kind of after we started this whole world of free the printing press, I guess. So those numbers actually get kind of interesting with the Fed's balance sheet. So And let me kind of preface with the fact that the balance sheet itself doesn't really mean much. The fact that the Fed is having to buy assets off of the market and park them on their balance sheet, this is how much risk are they trying to pull out of the market so we don't get another 2008, right? So the idea was after all of those bad mortgages started to default, the Fed was buying them up so that when they defaulted, they would just print the money, right? It was a way to socialize the risk while we privatized the gains. But anyway, so as this Fed balance sheet increases, that means that they're carrying more and more junk, right? They're taking more and more junk out of the system so it doesn't collapse upon itself as we print more money. So anyway, January of this year, 8.9 trillion. A year ago was 7.3. So they've actually bought up 21% more assets than what they held last year. You go back pre-COVID, they had 4.1, so they've more than doubled what they bought as a response to COVID, getting a bunch of junk off of the market. And then go all the way back to 2010, 2.2 trillion. So they've gone up almost 300% on what they had before all of this crazy stuff started happening. With you go all the way back before the printing press was really kicked into high gear, and it was like 800 billion. So I mean 0.8 is what we saw there is like a real baseline, but it immediately jumped up with the bailouts. That was when they were buying up a lot of stuff. So I kind of wanted to see a baseline there. Now comparing the two, we've got 12% more money floating around, and we got 21% more junk that's going to have to be printed if and when it defaults. There's going to be some value in there, right? It's not like people just stopped making their payments, but still, that's a lot more junk. You go back to pre-COVID, 41% more dollars floating around, and they had increased by 113% over that balance, trying to get that junk out of the way to prevent another financial collapse. And then 155 versus 300, it's almost twofold, right? Is what we're seeing on the diluted buying power, as well as the stuff that they've had to take off of the market because it might implode and cause liquidity crisis and all this other stuff. So none of this is good info. Just to track the numbers here, this is where your inflation comes from, and this is the economic risk that we're facing. So hopefully that kind of explains that. So now we'll get into the actual asset class performance, and there's a slightly different, I'm using the box, the equity box, on how we're tracking all of that. So it should be a little bit easier. We're going to go month to month now so that you could just watch each video. So come on back for the asset classes. And we're back. So this is the new format that we're doing, and I'm mainly just focusing month to month. So if there's something that's major about a year to date, I'll throw that up there just for reference. But I think if I can get on this kind of a trend for those of y'all that care about these asset classes, this is the simplest way to look at it. And this actually looks more like how we look at it in client review meetings anyway. So if you recall our equity style box here, we can have large caps, mid caps, small caps, value, core, or blend, and growth. So if I say core or blend, there's the same thing. It's the middle section there. So let's just talk about U.S. equities here. Continuing to sell off more or less. The small caps had a little bit of a buffer there, some positives in this bottom left corner here. Your large growths, small growths, it's kind of inverted. We would expect to see a bigger sell-off on the small growth rather than the large growth, but this is continuing. In fact, the year to date, we're 15, 15, 16 on the downside. We are 6, 7, 9, and then these are zeros. And actually, I think large is down, small is up on the year to date. So value rotation, you remember we talked about this last year. It was at the end of the year market update. The growth value rotation, right? That's the big key, and it's playing out right now. So back in September was our last major reallocation. We went heavy in value, and we got really light on the growth side, and yay, we're happy about that. Real estate continues its sell-off. It's down 12 year to date. It continued another -4 for the month of February. Oil's up 30 year to date. It's continuing. It's up 10 for the month of February. Gold is continuing its increase. This one's kind of surprising. I just think that in the world of Zoom, you know, and the types of businesses and our supply chain and all of that stuff, that real estate maybe was already overvalued, so maybe it's just a slight correction instead of a big shift in how we're looking at real estate, but just continue watching this to see if it continues dropping. So we're still very light in real estate. To move over to actually a little bit more stocks, international and emerging market, that's pretty much on pace. Year to date, it's not. Year to date, we would have expected to see a higher emerging market loss than international, and that's not the case. It is for the month of February, but January was flipped. Bonds, which we're going to cover here, short-term, intermediate, that makes sense. Long-terms are just getting hammered, right? So we got way out of long-terms in September. We went into short-terms and tips, which ended up being good. High yield is starting its drop, down 1%. Again, that's as we're backing off of QE, as the Fed buys a little less junk off of the market. We're starting to see people pivot away from the high yield side of it. I think just risk aversion is kind of where people are with the uncertainties going on with our fiscal policy, geopolitical stuff going on, supply chain or supply structure. Yeah, it's just people are averse to risk, and tips have actually been doing their job, which is pretty cool. S&P is down 3%, another 3% for the month of February. Dow Jones moderate type portfolio would be down 1.28. So that's less than 0.5% of the volatility. We're starting to see things look more normal in this correlation here. It used to be that when growth would take off and value would tank, that the moderates would take a much bigger hit than expected, and now we're seeing it normalize a little bit. And you can see how January factors into that. Year to date, S&P is down 8. The moderate portfolio is down 5. A lot of that comes from the long-term bonds, but yeah, this is what we're seeing for the month of February. I haven't included March numbers at all, but that'll be coming out shortly since we're halfway through March by the time I'm filming this. So as always, if you have questions, put them in the comments. Give me a call, text. If you see me around town and want to chat, you know I like talking about it. So anyway, we're here to help. I hope this is informative. Hopefully this, I know it's a long video. They're all long videos because there's a lot to talk about for those of you that are interested. So everybody get more interested in this. This matters a lot to your financial situation. But call if you have questions. We'd love to talk about it.